Welcome to the Pro Ticker Deep Dive. Today we have a really clear mission. We're here to unpack some sources that detail a truly fundamental shift in the global energy landscape.
And we really are moving past the old arguments, about oil and gas.
Completely. The future of global infrastructure, it's being decided right now by the supply chain for batteries, the capacity of silicon wafers, and maybe most critically, by the insatiable, just ravenous demand coming from AI data centers.
Yeah.
So we're deep diving into the companies that are really poised to capitalize on this generational shift.
And what's fascinating here, what the source material just lays out so clearly, is the sheer scale of this transition. I mean, this isn't theoretical anymore. It is happening right now. The projections show renewable energy consumption, and that's across power, transport, and heating is going to surge. We're talking over 50% between 2024 and 2030.
50%.
It's a generational wave, and it's powered not just by, environmental goals, but by hard economics. The costs are collapsing, corporate demand is huge, and we have these powerful, if a bit chaotic, policy tailwinds.
Exactly. And that word chaotic, I think that defines the entire playing field right now.
For sure.
That's why we're focusing on two key but very complementary players who are navigating this future. On one hand, the world's largest renewable generator, NextEra Energy.
Right.
And on the other, a dominant U.S. solar manufacturer, First Solar. But the real story, the bigger story, is this existential transformation of how America generates power, and how all this policy uncertainty is creating a frantic, high-stakes race toward a looming deadline.
The 2027 cliff.
The 2027 cliff, exactly. And that brings us to our first section, the macro backdrop, where this all just collides. Our sources describe it as an unprecedented collision of three massive forces. First, you've got a legacy power grid that's frankly running on fumes.
It's old, it's strained.
Second, you have this technology revolution centered on artificial intelligence that is consuming electricity like nothing we have ever seen before.
Nothing.
And third, an incredibly chaotic, politically charged landscape that is shaping every single investment decision.
And if we just zero in on that demand side for a second, it is stunning. Global electricity demand is projected to increase by a massive 75% by 2050.
75%.
Yeah, and the primary engine driving this explosion, it isn't residential use, it's not even manufacturing. It is data centers.
Just data center.
The forecast for U.S. data center consumption alone is it's staggering. By 2030, they could consume anywhere from 345 to 490 terawatt hours annually.
Okay, that's a huge number. Can you put that into perspective for us?
Sure. So to help you visualize that magnitude, that single industry could consume between, say, 36 and 51% of Virginia's entire current electricity consumption.
Wow. And Virginia is already a major data center hub.
One of the biggest. So that really frames the urgency.
It does. It creates this incredible urgency on the supply side. And that's why the deployment numbers for next year are just so critical. The U.S. is expected to add about 63 gigawatts of new utility-scale generation capacity in 2025.
Right.
But here's the key takeaway for you. 81% of that new capacity is going to come from solar and battery storage combined. We are literally watching the grid structure change in real time.
But this huge supply push is happening even as policy creates these massive headaches. And that's really the heart of the policy paradox we were talking about.
Right.
We've seen this new legislation, referred to by many as the One Big Beautiful Bill Act. And this bill, while it initially provided huge support, it terminates the valuable investment tax credit and the production tax credit.
The ITC and PTC.
Exactly. For any wind and solar facilities that are placed in service after December 31st, 2027.
Okay, we need to pause and define those for a second because they are absolutely central to this entire deep dive.
They really are.
The difference between those two credits, that's what defines the urgency. So the investment tax credit, the ITC, that's a credit on the upfront capital cost. It rewards deployment.
Right, building the thing.
Building the thing. But the production tax credit, the PTC, that rewards the operational output. So how much power you actually generate.
Exactly. And because the ITC rewards that capital deployment, investors and developers know they have to commence construction by a very specific date. July 4, 2026.
That's specific.
That's the date to lock in full eligibility for those tax credits. You can't wait until 2027 to start digging. This compressed, high-stakes timeline means billions in capital has to be deployed immediately.
It creates this frantic race to that 2027 cliff.
It does, because otherwise they risk losing the economic viability of the entire project. And that urgency to build so quickly, it immediately highlights the next major challenge, storage.
Right, the missing piece.
The critical missing piece. Because storage is what transforms intermittent power sources, solar and wind, into 247 dispatchable power. It stabilizes the grid exactly when these AI data centers need absolute reliability.
And the only reason this is even possible is the cost collapse in batteries.
The only reason it's been radical, lithium-ion battery packs averaged about $115 per kilowatt hour in 2024.
And that's down from what?
That is an 84% reduction from just a decade ago, and a 20% drop from the previous year alone. That's the fastest single-year reduction we've seen since 2017.
So that cost collapse is just fueling explosive market growth.
Absolutely.
By October 2025, U.S. operating storage capacity had already hit 37.4 gigawatts. That's up 32% year-to-date. The broader market is projected to grow at a blistering 13.6% compound annual growth rate all the way through 2035.
The fundamentals are there.
The fundamental economics are clearly screaming, go.
But, and this is a big but, here is where that policy turbulence undercuts the pure technology wave. While battery tech is advancing, tariffs on key input materials like copper, steel, components from Southeast Asia. They've increased overall project costs by up to 30%.
30% is a huge number. That can kill a project.
It has. This isn't just an abstract cost issue. It has a direct material impact. We saw a record high $6.9 billion in project cancellations in just the first quarter of 2025 alone.
Wow.
And that's driven primarily by this policy instability and rising costs. And, to visualize $6.9 billion in canceled solar capacity for you, that's roughly enough to power 3 major U.S. cities.
Wiped off the map?
Wiped off the map by tariff uncertainty.
That is a staggering realization. Okay, so since the economics of storage are clearly viable, but the policy risk is just escalating project costs. Let's turn to the corporate strategies. How are companies trying to navigate and win this race?
Right.
We've got NextEra Energy and First Solar, 2 fundamentally distinct paths.
Very different approaches.
Let's start with NextEra, the integrated powerhouse. Their strategy is, well, it's pretty genius because it hedges that policy risk. They combine a highly stable, regulated utility floor to power and light, which generates about 35% of their adjusted earnings, with competitive, high-growth, renewable developer, NextEra Energy Resources.
It's a great model.
It seems to be working. In Q3 2025, they reported adjusted EPS of $1.13, beating consensus by almost 8%. They added a massive 8.7 gigawatts of new projects in 2025 alone, and they're committed to installing over 30 gigawatts of capacity by the end of the year.
And that hybrid structure, that's what provides the crucial downside protection. The regulated utility part, floor to power and light, it's allowed guaranteed returns that are approved by the state. So this acts as a sort of predictable anchor.
The cushion.
It's a cushion, exactly. It cushions the volatility that's just inherent in the competitive renewable development market. And investors who are looking for stability, they love that buffer.
But wait a minute. In the middle of all this solar and battery surge, the source material notes NextEra is diversifying. They signed a 25-year power purchase agreement with Google to get carbon-free nuclear energy. And they're restarting the Duane Arnold Energy Center to supply that demand. So why would a pure-play renewable giant need to restart a nuclear plant? Is that kind of an admission that renewables alone can't meet that 2047 corporate demand?
That's a great question, and it really speaks to the sophistication of the demand side now. The major tech giants, they aren't just looking for cheap intermittent power anymore. They're demanding 2047 baseload carbon-free power. And right now, only a blend of, say, solar plus storage plus non-intermittent sources like nuclear or geothermal can fully meet that constant around-the-clock demand profile.
So they're just meeting the market where it is.
Exactly. NextEra understands that selling all of the above carbon-free solutions gives them a huge competitive edge over rivals who only offer solar and wind.
That makes a lot of sense.
Yes.
Okay, now let's look at First Solar, the manufacturing mode. They are a pure-play solar module manufacturer, but their big advantage is their heavy focus on domestic U.S. production. They are specifically leveraging what the industry calls Foreign Entity of Concern, or EOC, restrictions.
And those are basically rules designed to protect the domestic supply chain.
Exactly, to protect it from competitors who are heavily reliant on Chinese source components. It creates a protective moat right here at home for them.
And that moat is massive. Their scale is huge. Q3 2025 revenue hit $1.59 billion, which comfortably beat the estimates. Their backlog, it extends all the way through 2030. It's 54.5 gigawatts.
54.5.
And over 15 gigawatts of that is dedicated specifically to U.S.-made modules. So they've clearly executed. I mean, just look at their stock. It surged 28.53% year over year.
However, the policy headwinds, they affect even the winners, right?
Oh, absolutely.
Despite all that success, First Solar had to revise their full-year 2025 guidance downward, and they cited near-term challenges presented by the new tariff regime.
Right. So even being domestically focused doesn't completely insulate you. You still rely on global materials.
Of course.
And we should also mention their proprietary thin-film CAD-TEL technology is a key competitive advantage. It helps them stand out.
How does that work?
Well, think of it this way. Traditional silicon solar cells, they degrade faster in really harsh heat and humidity. First Solar's thin-film CAD-TEL is less prone to this degradation. And that gives them a critical edge in these large, sunny U.S. markets where durability is just paramount.
That's a really interesting tech advantage. So if we contrast their market characteristics, you can see the risk profiles really clearly defined.
Very clearly.
You have NE, the regulated utility hybrid, which is stable, a 10.66% return over the last year, very low volatility at 1.22%. It's your utility-like safe harbor.
Right.
FSLR, however, is a high-growth, high-beta stock. You get that 28.53% return, but with significantly higher volatility, almost 4%.
And that higher volatility, that's just the market pricing in higher policy risk. Interestingly, though, FSLR is trading at a significantly lower PE ratio, despite having faster earnings growth expectations. And this really reflects the market's differential risk assessment.
So what's the logic there?
The logic is NEE offers stability and predictable guaranteed returns. FSLR, on the other hand, offers pure exposure to policy-driven manufacturing growth. That makes its earnings stream much more susceptible to sudden changes in tariffs or, those domestic protection rules.
So, okay, what does this all mean for the future? Let's try to summarize the bull case for the whole sector.
Okay.
It seems to be driven by three things: exponential data center demand,
Unquestionable.
continuously falling battery costs, and this urgent, tangible race to deploy capital before that looming tax credit deadline.
Right. But the primary bear case, it hinges entirely on that policy cliff. The One Big Beautiful Bill Act presents a material and existential threat to the sector's growth trajectory.
And what do the numbers say there?
The industry estimates suggest that once the ITCs and PTCs disappear after 2027, new renewable capacity additions in that 2028-2030 period could be reduced by a staggering 40 to 50%.
40 to 50, that's a collapse.
It's a collapse. Policy durability is the key risk here, and that July 2026 construction deadline is what defines the next 2 years.
And of course, we also have to consider the company-specific risks.
Always.
For First Solar, their entire success depends heavily on that continued domestic protection, the FEOC rules. If global competitors suddenly manage to scale up domestically, or if those tariffs are reduced, their current premium pricing power could just evaporate.
It could, quickly. And for NextEra, while they have that enviable regulated stability, they are subject to regulatory scrutiny on their Florida power and light segment. And remember, that's over a third of their earnings.
That's a big chunk.
It is. Plus, any large infrastructure developer faces serious development risk, permitting delays, supply chain disruptions, or rising interest rates, which directly increase the cost of capital for these massive multi-year projects. So this all raises a really important kind of existential question for you, the listener. Policy durability is the key factor that's going to determine future value. If pro-renewable policies were suddenly to return and get extended past 2027, well, the urgency and therefore the high valuations tied to this frantic race, they might deflate.
Right, the pressure comes off.
The pressure comes off. But conversely, if the current tighter policy regime persists past 2027 and those tax credits vanish, growth opportunities could be materially constrained for the entire sector for years to come.
So here's the core conclusion we're drawing from all this material. The energy transformation is real, and it's proving to be highly profitable.
It is.
It's being driven by immediate, tangible power shortages and relentless corporate demand. AI needs the power. It's not just about abstract climate goals anymore. The economics of solar plus storage have fundamentally shifted past the point of no return.
I think that's exactly right. The wealth creation opportunity here lies in recognizing this overwhelming secular wave, the AI demand, the continued fall in battery costs. But you must, as an investor, respect the major policy risk that makes 2027 a watershed moment.
A watershed moment.
It is the defining regulatory uncertainty of the decade for this sector, and companies are literally racing against the calendar to overcome it.
So our final thought for you to consider is this. What are the implications if the massive power demand from AI development accelerates past even the most aggressive current forecasts?
Hmm.
How quickly would the regulatory environment be forced to adapt and close that energy gap if the lights started flickering in data centers? See you all in the next Pro Ticker Deep Dive.